Hi, everyone. Thank you for joining us today for our webinar on modernizing scope to accounting for maximum impact. My name is Natalie Valentin with Granular Energy. And this morning, the Clean Air Task Force published a white paper co-authored with both Granular Energy and the Northbridge Group. And this morning, we're excited to share the highlights of that paper with you, as well as dive into its implications and our recommendations for putting those into practice. So before we get started, just a few housekeeping items. First, today's webinar is being recorded and transcribed. And after the webinar, you'll receive an email with both the recording and a copy of the white paper. As for the run of show, we will hear remarks today from 3 of the paper's co-authors. We'll then have about 15 minutes at the end for Q&A, and you're welcome to drop questions and comments into the Q&A at any time, but we will be answering those at the conclusion of the presentations. We have a great mix of both energy buyers and suppliers in the audience today, so we look forward to a robust discussion. Very pleased to introduce our 3 speakers today. First, we have Armand Cohen, who is the Executive Director of the Clean Air Task Force, a global environmental organization that catalyzes policies and private sector actions to commercialize zero carbon energy. In 2019, the Clean Air Task Force was the first environmental organization to advocate for time-anchored greenhouse gas electricity source accounting. We also are joined by Neil Fisher, a partner at the Northbridge Group, which is an economic and strategy consulting firm where he's worked for over 30 years with US electric utilities. For the past 5 years, Mr. Fisher has partnered with the Clean Air Task Force on the next generation carbon-free electricity procurement initiative to empower electricity buyers to decarbonize the grid. Lastly, we have Toby Ferenzi, who is the co-founder and CEO of Granular Energy, the leading provider of energy attribute certificate management software that currently supports the world's largest 24/7 carbon-free energy programs. Dr. Ferenzi is a serial energy entrepreneur, as well as the founder of Energy Tag, the nonprofit international standards body for real-time energy tracking using granular certificates. To kick us off today with the history of this collaboration and its importance, I will pass the mic to Armand.
Thank you, Natalie. I'm just going to be very brief and explain the motivation for this research, which is the culmination of about 4 or 5 years of work. So as everyone knows, the movement towards large corporate procurement of clean energy kicked off maybe a decade or more ago. The initial focus was on 100% renewable energy, and that was hugely successful, moved the market substantially, and is just a success by any measure. However, about 6 or 7 years ago, CATF looked at this and said, okay, well, that's great. But the research that we were doing and that many other groups were doing were concluding that to fully decarbonize power grids, we're going to need some complementary technologies that run 24/7, 365, and are available to complement weather-dependent resources like wind and solar. And so we took a fresh look at the existing procurement practices and scope to accounting and said, you know, there's something missing here. We need to sort of look at what else other parts of the market we need to move. So there were really essentially 2 problems with the current framework. The first was that with all the successful 100% renewable publicity and claims, we felt there might be left an impression, problem solved. The corporates have solved it. Now all government has to do is do the same thing, and then we're done. And we felt like that was a misleading message for policymakers. The second point, and the more profound point I think here, is that there was a huge missed opportunity, again, with first generation accounting and first generation procurement, which is that while it did massive success in scaling renewables, the market power, the market force to bring forth other complementary technologies was missing from the incentive and from the market signals. And so we looked at those two deficits of the current model and said, how can we address this? And the first part of it was to analyze what was missing to get that message out there, to kind of socialize the idea that to fully model grid decarbonization and to move the markets, corporates were going to have to start thinking more about the full spectrum of decarbonization and actual consequences on the grid, as opposed to just trading certificates. So that's the basis of this research. And in addition to the problem statement in the report that we're releasing today, there's a whole lot about potential solution pathways. So with that, I'll stop as a framework and turn it over to the real experts.
Thank you so much, Armand. I'll now pass it to Neil, who will take us through more detail on why changes to the market-based Scope 2 are needed and the specific recommendations of our new white paper.
Thank you, Natalie, and thanks to Toby Ferenzi and Granular Energy for co-authoring this report and hosting this webinar. And I want to thank Armin, too, and the Clean Air Task Force for supporting this work. We're excited to release this new report. When should companies be able to claim they consume carbon-free electricity, or CFE? 3 topics I want to cover. First, my take on the grid decarbonization challenge, and a brief overview of the electricity procurement strategies that are being performed today. And then I want to focus mostly on the Scope 2 market-based accounting and issues and recommendations. Much of my career has been spent helping clients balance electricity supply with demand from a physical reliability and a financial hedging perspective. To do this balancing, we rely on a mix of firm baseload, intermediate cycling, and peaking resources. Fossil generation is often used to cycle on and off, ramp up and down. To address climate change, we need to A, clean the grid, and B, electrify as much as possible. The challenge is how to transition from 40 to 100% CFE when deeply decarbonizing the economy is expected to require more than a doubling of electric demand, tripling generating capacity, and doubling the transmission grid by mid-century, requiring an unprecedented infrastructure build-out like nothing experienced in recent times, while addressing other issues like land use, supply chain, siting, permitting, interconnection, labor transitions, and so forth. Substantial research, and we've done a whole nother study on this, looking at over 40 studies, indicates that the fastest, most cost-effective, and reliable pathway to grid decarbonization is through a diverse portfolio of CFE technologies, including wind and solar, along with firm CFE and advanced storage technologies. So there's just 3 key success factors to decarbonize that I want to highlight. First, we need a mix of deliverable CFE supply to meet demand reliably and affordably. Second, we need to make significant investments in incremental CFE resources and retain existing CFE as much as possible while demand increases significantly. And third, we need to replace the balancing functions of unabated fossil generation to drive impact as soon as possible. The good news is that in recent decades, electricity buyers have become a growing force in clean energy deployment. Starting in the late 1990s, renewable energy certificates were created, which support both compliance with state renewable portfolio standards and voluntary purchases. In 2014, the RE100 initiative started, encouraging companies to match annual renewable energy production with annual consumption. Over 400 companies have joined RE100. Since the mid-2010s, corporate power purchase agreements with new wind and solar projects have increased significantly. And in September 2021, the UN launched the 24/7 Carbon-Free Energy Compact, encouraging companies to match deliverable CFE supply with hourly consumption. Over 140 organizations have joined this compact. And in December 2022, the Emissions First Partnership was created, encouraging companies to make CFE investments globally to displace the dirtiest fossil generation. All these procurement strategies continue today, and they can be pursued in combination or independently. And while corporate goals, abilities, and access to markets differ, and not all data is readily available, customers should be empowered with a range of options to accelerate grid decarbonization. We're not mandating one approach, but regardless of the procurement strategy chosen, we need to better measure and report real progress. We need to be able to recognize the difference between A+ and C- work. Almost universally, the Greenhouse Gas Protocol's corporate standard and Scope 2 guidance is used to measure progress. It's the world's most established and widely used accounting standards, and in many ways, the protocol has succeeded. Thousands of companies have set voluntary clean energy and emissions reduction goals. Nearly 19,000 companies, worth over half the global market capital, report environmental disclosures to CDP, an international nonprofit, using protocol standards. The bad news is greenhouse gas emissions continue to rise, and society can't afford actions and expenditures to support claims of progress while not reducing real-world emissions. In recent years, there's been growing recognition that companies that follow the rules and procure 100% renewable energy continue to consume and rely on fossil generation. This has damaged the credibility of the greenhouse gas reporting system and raised concerns about corporate greenwashing. I'm sure you've all seen articles like this in the paper. A company's report of zero Scope 2 market-based emissions can be misinterpreted to suggest that they use 100% renewable energy to support use claims, or have actually reduced emissions by taking the equivalent of X number of cars off the road to support impact claims. It can imply that a company's environmental mission has been accomplished despite continued reliance on fossil resources. The problems with the protocol have been discussed elsewhere, but I want to highlight three. First, Scope 2 doesn't accurately measure the emissions associated with purchase supply that serves the timing and location of electricity use. Without better location matching, the emissions associated with electricity use on a local grid, shown on the left, can be erased with RECs purchased from a distant grid, allowing companies to consume fossil generation and report zero emissions. Without better time matching, excess RECs in daytime hours, for example, from a solar facility on the same grid, can be used to erase fossil emissions consumed in nighttime hours. To be fair, the protocol relies on RECs that were, by design, separated environmental attributes from physical deliverability of power. But our environmental goals have evolved, and rather than just put CFE where it's most economic, we now also need to develop the mix of resources needed to deliver clean energy to all grids at all times. Installing wind in Oklahoma won't help provide clean energy to New York City when needed. So the second problem is that the current system doesn't recognize the value of firm and flexible balancing resources that Armin was talking about. I can zero out my Scope 2 emissions inventory with just wind or just solar. So no batteries, firm or flexible CFE is required to achieve zero Scope 2 emissions. Third, Scope 2 doesn't estimate and prioritize decisions that actually reduce emissions. Again, to be fair, the Scope 2 guidance acknowledges that it was not designed to estimate what's called avoided emissions. It's all about allocating emissions from all generation to end users. Instead, the guidance provides standards for another type of analysis referred to as project accounting. The problem is that project accounting is optional, rarely used by companies, and often ignored by leadership and recognition programs. Therefore, impact metrics are either absent or a low priority within target setting programs and disclosures today. The protocol update process currently underway is the best opportunity to improve the market-based method, to maximize the contributions that electricity buyers could make to meet our goals in time. The current plan is to finalize and publish updated standards and guidance by the end of 2026. Given the problems I've identified, some suggest that the market-based method should be eliminated or fundamentally changed. Instead, we recommend it be retained and improved for two main purposes. First, to enable companies to more accurately report emissions from supply purchases serving their electricity use to support use claims. And second, to accelerate the growth of all CFE resources necessary to fully decarbonize electricity grids, not just wind and solar, but ensure the mix of resources needed to follow load. But matching clean energy with hourly consumption is not the same objective as prioritizing investments to displace the dirtiest fossil generation wherever, independent of the timing and location of your consumption. We believe both goals are important, and we should be able to measure progress towards both goals as accurately as possible. If a company's consumption is in Massachusetts and they want to invest in a solar farm in Australia that displaces fossil generation, then they shouldn't be able to claim they consume that CFE, but they should be able to be recognized for the impact that they cause. We need to deliver clean energy to consumption, and we need to be smarter about making investments, since not all CFE, even if additional, has the same climate benefit. Since many large companies operate in multiple markets, estimating emissions impacts can also help prioritize where and when to first match their hourly consumption. That's why we also support better assessment and reporting of emissions impacts. We are releasing a companion report today, co-authored by CATF, Northbridge, Green Strategies, and Ben Hobbs at the Johns Hopkins University, that describes how market-based inventories to support use claims and consequential accounting to support impact claims differ, and why both are essential to measuring and incentivize progress. To improve use claims, we have 5 recommendations. I would describe each in the following slides, but at a high level, the first 2, location and time matching, have received a lot of attention, making inventories reflect purchase supply that is deliverable to the location and timing of consumption. The third relates to CFE equality. It's needed to coordinate required CFE purchases like RPS or Utility Standard Delivery Service with voluntary purchases to prevent double paying for CFE. The fourth and fifth recommendations relate to energy attributes, EAC ownership, allocation, and integrity to improve how EACs are allocated and to avoid double counting and cost shifting. For my friends out there who maybe don't know what EACs are, they're like RECs, but include all forms of CFE. So it would include hydro and nuclear in that as well. One key question is, what's the appropriate market boundary for matching supply and demand? There's a lot of discussion about this. Currently, RE100 allows companies operating in the US to claim certificates anywhere in the US or Canada. In Scope 2, market-based accounting, anywhere in the US counts. Several options are being considered to narrow this boundary, using ISO RTO regions like shown in the center, or more granular market load zones with the same market prices, or using regions defined in DOE's National Transmission Needs Study, which U.S. Treasury has proposed for the clean hydrogen regulations. Again, the purpose of location matching is to create demand for CFE deliverable to all locations. When determining the market boundary, key considerations are transmission and trading. If the boundary is too large, people complain it ignores transmission congestion within. If it's too small, it ignores trading across areas, making it too hard, expensive, and the market too illiquid. If it's too fixed, it ignores temporal changes in deliverability. And if you try to adjust for these things, it becomes too complicated, not practical. To be clear, we're not trying to make things too hard, expensive, or easy for that matter, but rather more accurate and relevant to address the realities of grid decarbonization. We deal with these kinds of realities every day when buying and selling electricity. Therefore, we suggest making hourly EACs tradable like physical power, defining a market boundary safe haven where EACs can be counted without question considering congestion, and if outside that boundary, additional demonstrations could be required to allow for trading. Improved Scope 2 market-based emissions should be calculated hourly, not annually. And excess CFE in an hour should not be counted in another hour. The purpose of time matching is to create demand for CFE when it's needed most, to fill in those non-CFE gaps, so that suppliers consider all the CFE resources required to follow load. To match supply and demand efficiently, suppliers will need to assemble a portfolio of resources, aggregate load, and trade hourly EACs, similar to how they provide electricity. Now I want to shift gears to talk about CFE equality and allocation. It's especially important that existing CFE, which represents 40% of US generation, and any new CFE be properly allocated to customers. Customers should be able to count equally their fair share of all EACs purchased and retired, either directly or on their behalf by their supplier. But to make this possible, CFE first needs to be tracked and allocated to the load who pays for it. In today's accounting, companies can sometimes claim to consume CFE they don't purchase that are financially supported by other customers. In other cases, companies can't claim attributes purchased on their behalf, and not all CFE receives the same accounting treatment. Let me just give you a few examples. Compliance or mandatory CFE attributes which satisfy RPS or clean energy programs are usually tracked, verified, and retired, but often are not allocated to the customers on whose behalf the attributes were purchased. A bigger problem is what I call utility non-bypassable CFE. This CFE doesn't meet state RPS requirements, but it's mandatory. Think hydro or nuclear rate-based generation in regulated states without supplier choice. Or restructured states with supplier choice, many customers are required to pay their share of the cost to extend the lives of economic lives of nuclear generation, backstopped by state legislation and utility non-bypassable charges. These EACs are not typically allocated to customers who pay to keep these plants operating. And even if nuclear and hydro generation is included in a supplier or residual mix, bundled with non-CFE resources, it's difficult to use this CFE to achieve zero Scope 2 emissions. So even if you're paying for 60% deliverable CFE in your supply mix today, you may have to purchase RECs to match 100% of your annual consumption to zero out your Scope 2 emissions. So based on analysis we've done, almost 3/4 of existing CFE in the US is required. We need to allocate this CFE to ensure no double counting, no double paying, or cost shifting. Put simply, customers should be able to count what they pay for and not count what they don't pay for. We need to fit the CFE pieces together so that they complement rather than compete. If companies are required to purchase compliance and utility non-bypassable CFE, those bottom pieces, puzzle pieces on the diagram, but can't fully count these purchases in their inventories, it's reasonable to expect them to oppose the expansion of these clean energy policies. A sustainability person at a global company told me that the worst part of their job was being put in the position of opposing country or state policies to expand mandatory clean energy programs simply because they couldn't use these required CFE purchases to achieve their company goal of zero scope 2 market-based emissions. Instead, they were incentivized to make voluntary purchases of RECs with lesser impact. A Scope 2 emissions inventory provides a snapshot of where a company ended up in a prior year. It doesn't reveal where a company started, what was required, what was voluntary, or what incremental impact they had on grid emissions. An analogy I often use is when driving to California, it's helpful to know whether you're starting in Maine or Arizona. Allocating required CFE purchases could establish a baseline or starting point so that voluntary procurement can be added to what already is required. Depending on the service area, this CFE starting point ranges from 0 to 80%. Obviously, going from 80% to 100% has different costs and impact than going from 0 to 100%. To determine what percent of a company's consumption is supplied by CFE should examine the absolute level of the CFE score. Did the customer make it to California 100% or not? To determine what voluntary effort a company made, compare the difference in the current and baseline CFE score. Did the company travel to California from Arizona 80 to 100% or Maine 0 to 100%? To assess whether company actions are linked to emissions reductions, you need to estimate avoided emissions. What route did they take to get to California? Did they do anything that could directly reduce grid emissions? The accounting and recognition programs should be modernized to measure and assess these relevant questions. Finally, I want to emphasize that EACs should be used to substantiate claims of CFE use. Ownership rights should be fairly allocated to customers who purchase them. LSCs, load-serving entities, the suppliers should allocate these EACs to customers. These concepts have been discussed by others, and there's several good examples and best practices to follow. But too often, this allocation of CFE to customers isn't done. To maintain the integrity of EACs, companies should be able to point to an EAC they or their supplier retired on their behalf. Generic supply from the grid without proof of EAC purchase should not be assumed to include CFE, and required CFE purchases by customers, even if they're not claimed, should not be permitted to reduce the emissions of other customers. We don't want to simply redirect or reshuffle existing EACs that are already required by legislation or regulation to be used by customers meeting voluntary procurement goals like 24/7 or RE100. Without EAC purchases, fossil emission factors should be applied using the best available information. And we've developed a data hierarchy to better define what this means. When customers or their supplier purchase and retire EACs associated with deliverable CFE matching a company's hourly electricity consumption, companies should be able to claim they are using CFE. This will reduce the risk that consumers aren't misled by claims about the energy used to produce the goods and services they consume, and help protect reporting companies from accusations of greenwashing. To support use claims, we need deliverable CFE that matches the location and timing of consumption, and we need to better allocate CFE to those who pay for it. And to support direct impact claims, we need to begin to identify changes and estimate impacts to the grid caused by company actions. Our climate goals have changed since the accounting and disclosure standards were created. We need to better measure and recognize actions that matter to achieve our climate goals. Thanks for listening, and I'll turn it back over to Natalie.
Thank you so much, Neil. To wrap up our presentations before we jump into Q&A, Toby will discuss the practical implications of these recommendations as well as what's required to implement them. And just as a reminder for folks who may have joined us a little bit late, we'll have about 15 minutes for Q&A at the end of the presentations. And you are very welcome to drop your questions and comments into the Q&A in the meantime. Take it away, Toby.
Great, thanks very much, Natalie, and thanks a lot to Neil for giving a great presentation of the main results. This is really a topic that we care deeply about, and I guess by way of background, my interest in this topic came from working on a previous company which was doing demand response, which then was acquired by an energy utility. And I got really interested in the topic because we were selling 100% renewable energy to many of the customers, but we were also trying to get customers to enroll in a demand response program, and we were getting this question of, well, why do I need to do demand response if I'm already at 100% renewable energy, if all of my energy is coming from renewable or carbon-free sources? And so there was this kind of disconnect between those claims that were being made and what we know is going on, the physical reality of the electricity grid, and that's kind of why I think it's such an important topic. And so I'm just going to say a few words about Neil did the lion's share of the paper and the recommendations, but I'm just going to spend a few minutes talking about, okay, now we have these 5 principles, those recommendations, what's actually needed for us to go ahead and implement those recommendations at scale, and what's already being done today. I want to touch on the kind of the unique role that utilities, or as they're often called in the US, load serving entities, what is their role to play in the implementation of these recommendations. And finally, I just want to end on a bit of sort of why this matters. What's the prize if we actually do this? So Neil did a great job of pointing out these principles. I don't need to go into, again, why we need location matching, time matching, CFE equality, EAC ownership and allocation, and EAC integrity. But just to say that this is this is something to consider when managing EACs and allocations going forwards. And here are some of the things that need to happen. So the 3 things, there's actually a lot of things that need to happen in order for this to be fully implemented. And I'm not going to say this is a complete list, but I'm just going to focus on 3 things. So one is the first one is the issuance of EACs with a timestamp. I'll say why that's important. Number 2 is kind of EAC portfolio management and allocation. And the third is EAC markets. So when it comes to time-stamped EACs, this is a topic where there's actually been a lot of progress. There's been a lot of different other webinars and papers written on this subject. I'm just going to call out international standards such as Energy Tag, which actually provide a framework for tracking systems, the issuers of certificates, to be able to follow to add a timestamp. So the reason why the timestamp is important is because EACs already, energy attribute certificates or RECs, as they're known, carry a lot of information already, right? They tell you the location of the power plant. They tell you the age of when the power plant was built. They tell you the technology. They just don't carry the temporal information. They don't tell you the time when the electricity was produced. And so that's an exercise. There's a lot of momentum behind this. Energy Tag has got many of the world's largest energy companies and key players in the sector to together to create a voluntary standard around this. And what that's doing is it's driving change in the industry. And so if you just take the US as an example, most of the tracking systems in the US are now at least exploring what it would take to implement, to be able to issue timestamp certificates. There's a great paper from CRS called Readiness for Hourly that you can download. I really recommend taking a look at it. But already tracking systems like MRETs and PJM are already have the capability to provide hourly recs in some circumstances. So that's something that's kind of in the works, and it's happening. And then there's portfolio management and allocation. And as Neil was explaining, allocation of CFE to customers according to those 5 principles is really important. But it's not. It could be a significant amount of work unless it's automated, unless it's actually made really easy. And that's actually something that we do as a software company. We work with lots of utilities, LSEs, and other players in the energy sector. And there's several aspects to it. One is portfolio management, really understanding what's the demand for different types of EACs from customers in your portfolio, and what do you have available, what's coming in to the portfolio. There's secondly the automation of allocations of EACs from, imagine a large generation fleet and a large portfolio of customers. How do you decide exactly which EACs go to which customer based on those different programs and the 5 principles? And so that's something that needs to be automated, along with the reporting, the actual provision of information and reports, both of EAC allocations and of the resulting carbon emissions to customers. And so there's actually, I'm pleased to say, like lots of technology being developed in this area to make that potentially complex process actually quite straightforward. But just to say, there's lots of different allocation criteria. You could imagine, a simple annual match green tariff is one kind of allocation rule where you're matching certificates that are EACs from greeny eligible generation sources. That's a simple version of an allocation rule. More complex rules are things like implementing the 45V requirements for green hydrogen that requires hourly matching, requires deliverable CFE from within a grid region, and power plants built within 3 years of the electrolyzer. So there's lots of, they do get much more complex, and that's why it needs to be automated. And the third point is around markets, right? And we do think that new market mechanisms are going to be needed. This is just the market structure today, right? Where you have, and this is a very simplified version, where you have wholesale power markets for the settlement process that grid operators run, and then you have a separate system of EAC markets. They're traded in different venues often. And you see lots of different types of products and instruments like corporate PPAs and green tariffs and so on. And this will, again, need to evolve. And what we're saying is just like very simply, as you move to temporal and locational matching, this will likely mean that EAC markets start to function a bit more like wholesale electricity markets. So a simple way of explaining that is that today we have the wholesale power market, which is a system organized by grid operators to match supply and demand between market participants on an hourly basis for the purposes of grid reliability, right? To keep the grid in balance and the lights on. And so it's already a 24/7 or hourly matching market. but it doesn't carry traceability, right? When you go to the power market, you don't know whether you bought coal or solar or wind. And that's kind of why we have these EAC markets, because they have the traceability. They allow you to see where your electricity has come from, but they're just based on annual matching today. So imagine you fast forward that to a future where you have, time-stamped EACs, where you're able to see where your energy is coming from, both location and time, on an hourly basis. And suddenly that sort of instrument or that transaction can be used for both the power market reporting and for your traceability. And so whether they're being aligned or eventually coupled, we see these two different markets actually starting to come together and operating in the same way. And that kind of gives a bit of a vision of where we see this going. When it comes to utilities and LSEs, we really think that utilities and energy suppliers play a key role in this. And you can think about that in terms of how the system works today, where suppliers are already responsible for matching supply and demand for all of their customers, whether you're a residential customer or a large business. You're always dependent to some degree on an energy supplier or utility to balance supply and demand. And so there's some key recommendations that are needed for this system to work. And that's, first of all, if you have some generation assets that CFE generation assets that are not getting EACs today, get those registered with the tracking system, so that like all of the electricity, the carbon-free energy, and as much fossil generation as possible can be accounted for through the EAC. And once you have those EACs, allocate them to customers according to those 5 principles that we went through, to make sure that customers, really get their fair share of the carbon-free energy that they've paid for. And then thirdly, provide this information to customers, through reporting and emissions reporting. And just to say, this may sound complex, but really it's already happening. And we are just what we only know about the energy companies that we work with already, which is over 30 of them across 10 different countries, many in the US. But we know that there's even more beyond this. And this is just one example from a utility that we work with that's actually providing hourly matching to all of their business customers. So not just the customers that come along and request it specifically under a bespoke contract. This is actually just a part of their service, is they're giving 90% hourly matching to all of their business customers. So it's just a point that is really happening. And the final point I want to make is, like, why does this matter? Why is any of this particularly important? And the answer to that is that, if we can get the greenhouse gas accounting right, this, we think, will empower businesses to turbocharge the energy transition in parallel with reducing their own emissions. So it's about aligning their own emission reduction goals with the needs of the energy system, so that the two go together. And we think that if in order to do that, you need to apply these 5 principles that Neil presented, and that will actually unlock billions of dollars a year of targeted investment for the energy transition. So something like over $10 billion was spent globally on EACs last year. So it's a lot of money. It's set to be $100 billion by 2030 as demand for net zero and emissions reductions increases. So we're talking about a huge untapped pool of capital that can be used to drive investment in all the technologies we need. So like a really simplistic way of explaining this, so in like the last 2 minutes, I wrote a piece a few months ago comparing buying clean energy to buying oat milk. And the point of this is to say, look, if you're an individual and you go to this grocery store and you buy a carton of oat milk, it doesn't necessarily have much impact, right? It's very difficult to understand, whether that one single purchase caused more oat milk to be produced. However, if thousands or millions of people all go to the store and buy oat milk, that starts to have an impact. And what it means is the grocery store can go to their supply chain, go to the producers, and they'll find a way to sign a contract to get more support, more supply, right? If they see demand go up on the right, they'll find a way to get supply on the left. And who knows, a bank might even come along and help to finance the increased production of oat milk, because the grocery store has provided them with a contract. And so that's really just saying, like, it's an illustration. The utility is the grocery store in this example, but by aggregating that demand, individual consumers can actually have a meaningful impact without individually needing to sign, long-term agreements. Like you don't need to sign a 10 years agreement for 10 years worth of oat milk in order to have this effect. And so what all of that means is that temporal and locational matching incentivizes the technologies that deliver clean energy when and where it is most needed, which then accelerates the transition to the carbon-free electricity system. So it's about pinpointing those hours when clean energy is scarce, when there's a shortage, and focusing investment in those hours rather than the times when it's already in oversupply. And that then means you've got this kind of technology neutral incentive to help decarbonization. So anyway, that's a quick summary. And yeah, I will hand back to Natalie. Thanks.
Thank you so much, Toby, as well as Neil and Armand, for your comments. We have about 12 minutes for Q&A. A couple folks have already dropped yours in, so please continue to do so. We'll start with Alex and Sahabia, who have related questions around, so maybe I'll combine them a little bit, as you've spoken quite a bit about allocation. So how should EACs and RECs be retired by suppliers on behalf of specific customers? And then what are the implications of that on their fuel mix disclosure? And how do you make sure that a given customer isn't oversubscribed or undersubscribed? So maybe Toby, you want to take that one, given your points around the importance of allocation. Oh, you're muted.
Yep.
Oh yeah, that's great. So I think yeah, what different countries have very different policies, right? And even within the US, depending on where you are, there's lots of different policies for about how that electricity is accounted for. Many countries or many regions say that if a generator has been subsidized, then actually it's not eligible to receive EACs even, and cannot, therefore customers can't claim the benefit. We're saying actually, if customers have paid for that clean energy through their electricity bills, then they should be entitled to the EACs from that, but only in proportion to their fair share, right? If everyone has paid equally for that, then it should be pro rata allocated. If not, then as Neil's guidance shows, that there are other measures you can do there, but in particular, it's the residual mix. Is working out what is the carbon. If you don't have EACs, then you have some portion of consumption which is not covered by EACs, you should use the residual mix calculation, ideally on an hourly basis, which is basically takes into account all of the remaining unaccounted electricity that was generated. But availability of data for residual mixes, particularly on the on an hourly basis, is not widely available, if at all. So we're saying primarily use in EAC, and if not, then there are some other measures, instruments that you can use.
Yeah, I would just add to that in the US, a lot of RPS requirements or the extension of nuclear plants are, sort of regulated by state, and that, that a lot of this stuff unfortunately isn't tracked and isn't claimed. And so if under the way the current methodology works, if it's not claimed, it goes into the residual mix, and then anybody in that region can claim it. And that's an example where, customers in Illinois could be paying to extend the lives of a nuclear asset, but customers in Ohio or somewhere else could be claiming it. And so I would say that, the CFE should be allocated on a load ratio share to all the customers in the state, that are paying for that to extend the lives of those assets or for renewable portfolio standards. And even if it's not tracked or claimed, I don't want to necessarily give that to the US government or to Google or somebody else doing voluntary procurement, because that's something that's required already and by legislation or by regulation. And so I want all the voluntary procurement to be on top of what's already required. So I think allocating by load ratio share and follow the money kind of thing, you know, give it to the people who are paying for it. And even if they don't claim it, that doesn't mean you give it away for free to somebody else.
Great, thank you so much. And I think Keith, Neil and Toby's answer addressed your question as well. But if you have a follow-up, feel free to drop that in the chat. Shifting gears a little bit more to the technologies at play here and being more inclusive beyond just renewable energy. Love this question from Stuart around storage and the role that has to play.
Yeah, I think clearly we need, we're going to kind of do this and decarbonize the grids. Clearly, we need a lot more wind. We need a lot more solar. We need batteries and storage and transmission. But to get back to the original, we need flexible and firm CFE resources that can close what I call the long duration gaps between variable renewable energy and consumption. So we've done a whole analysis of using existing storage, short-term storage that we have today, doesn't really close the seasonal mismatch between, wind and solar and consumption. It helps some, but it's not going to solve the problem. And I think this is a fundamental problem of decarbonization that we need to solve. What can realistically displace the balancing functions of fossil generation that we use now to balance the system? And right now, there's kind of three buckets. One is we got sort of mature technologies like existing nuclear and hydro that require life extensions and upgrades. Then we've got the second bucket, which had, like proven technology with cost premiums that include hydrogen. You can store and basically, produce hydrogen when you need it, and the carbon capture sequestration. Those things have cost premiums that's going to require learning by doing, getting the cost down, or government subsidies, and permitting of those kinds of resources. And then we need these other things, which are sort of demonstrated technologies that are sort of first plants under development, which include things like advanced geothermal, long duration storage, small modular reactors, advanced fission, those kinds of things that really, need sort of first of a kind demonstration projects. And those are the kinds of things that I think we need to actually solve the decarbonization problem, and the kinds of technology innovation and development that a time and location matching kind of forces you to get resources that follow load.
Yeah, thanks, Neil. Maybe just 2 seconds on like the mechanics of how this actually becomes a new revenue stream for storage that was not there previously. So when you have when you're doing time and location matching using EACs, what happens is there's a whole section of the energy tag standard devoted to storage that describes this mechanism. But essentially, batteries and other flexible sources can make money by essentially buying these certificates when they're in oversupply, when we expect them to be at a lower price, so that you sort of retire them against the consumption of the battery, and then when the battery discharges, it can have new certificates reissued that can then be claimed by consumers to fit in those missing hours, and the battery can then capture the spread between the low-priced hours and the high-priced hours, just as they do in the wholesale power market. And that's actually a mechanism that's been worked through and demonstrated now. But that's how we see this becoming a whole new revenue stream for these technologies that has previously not existed.
Yeah, I would also just add that all the accounting and measurement that we're talking about, we're not trying to pick technology winners here, or we're just trying to create, more accurate measurement and reporting that will incent whatever the right mix of resources are to solve this problem. We're not saying, oh, do this, do that. We're letting the market decide, and it will probably vary. It'll depend on technology development, it'll depend on economics, it'll vary by region. And so it'll depend on what gets government subsidies or not, and so it'll depend on a lot of different factors. And so we're really just trying to incentivize or create the demand for those kinds of resources to get developed.
Great. I think we have time for one more question. There are a lot of great ones in the chat. So if we didn't get to your question, we will follow up by email, and happy to continue the conversation. We just chatted a bit about pricing. So I'd like to get to this question about data availability. So can you speak to the data availability challenge, both on the generation and the consumption side, in order to enable the granular match? And how do we scale this to smaller customers, whether it's small businesses or residential?
Great. I can take that two seconds. So yeah, I don't think there's a data availability issue. I think it's a data accessibility issue. So the data, this hourly metering data, interval metering data that's needed, is widely available. So smart meter penetrations, AMI metering is becoming very widespread now, particularly for any business consumers and generation assets. And this data is actually used on a daily basis for power markets and settlement. And so what's needed is for this data to be made available. And in the work that we do, we actually help energy suppliers make this information available and do the matching on behalf of their customers in the same way they do with electricity supply in the power markets. But I think it's really about coming up with these common frameworks and introducing hourly timestamps on EACs would be a great way to achieve that, because then all generators, when they submit their generation data to the tracking system, which already happens, they would just be doing it on an hourly basis rather than on a monthly basis, right? And so you could actually have that access. So I think that accessibility issue will get solved, and yeah, we're finding lots of pockets where it's already been solved.
Yeah, I just said, I know this sounds, probably to people listening, this sounds daunting. Oh, I got to do hourly tracking, all this stuff. I think there's a big role here for utilities and suppliers that are in this business. They've been doing this. We've been doing 24/7 matching, megawatt hour matching, to match consumption for years and years and years. And, now we just have to figure out how to do it, that same thing, with clean energy. It's we still want it reliable, we want it affordable, and we want it with clean energy. It's like moving from 2 dimensions to 3 dimensions. And I'm working with a lot of young people, smart people like Toby here, that a lot of people are out there working on these issues to get better access to data in standardized formats. Google just published a paper on that. Supplier disclosures, an allocation of existing CFE, these granular certificates with timestamps. People are talking about trading of EACs, the hourly trading of EACs, and setting up markets, forward markets, spot markets. And so there's a lot that's happening now, and it's scaling really rapidly. And that I don't think necessarily individual buyers are going to have this in-house. This is going to be a service that utilities can offer with a green tariff, or a competitive supplier can offer customers, that says, we'll match your consumption with clean power by the hour, or we'll have these impacts. We can, estimate, put emissions. I know people are working on putting emissions reductions on granular certificate. People are working on a lot of different fronts right now that are going to make this easier for customers.
Thank you so much, Neil. I think that's a wonderful point to end on. We are at time. We will be sharing out an email with both the recording of this webinar and the white paper, so you can dive into this in more detail. We would love to have follow-up conversations if you have questions or comments. Thank you so much for joining. Have a great rest of your day.
Bye.
Great, thanks.
Thanks, everybody.